There is a financial ticking time bomb currently counting down in Washington, D.C., and the silence surrounding it is absolutely deafening. This is not a rumor. This is not a proposal being debated on the Senate floor. This is not a maybe scenario dependent on who wins the next election. This is already signed, sealed, and codified law. It is a scheduled event with a hard deadline. And when that deadline hits, the tax bill for millions of Americans is going to skyrocket automatically. The date is January 1st, 2026. On that day, the tax code as we know it today expires. The 2017 Tax Cuts and Jobs Act, which fundamentally reshaped the American economy, did not make its changes for individuals permanent. It came with an expiration date. When the ball drops on New Year's Eve 2025, we revert back to the old rules. Tax brackets will jump to higher levels. The standard deduction, which saves millions of families from itemizing, will be slashed nearly in half. If you are currently working, this is annoying. But if you are a retiree living on a fixed income, this is potentially catastrophic. You are about to walk into a buzzsaw of higher costs with almost no ability to generate new income to cover them. This isn't about red versus blue politics. I don't care who you voted for. The IRS doesn't care who you voted for. This is strictly about arithmetic. Welcome to Tax Hack Pro. In this video, we are going to expose the mechanics of the 2026 sunset, explain why the system is rigged to hit retirees the hardest, and most importantly, give you the specific strategies you need to implement right now to stop the government from confiscating your hard-earned wealth. The window to act is closing. Let's get to work. To understand why this is happening, we have to look back at the architecture of the 2017 tax overhaul. It was marketed as the biggest tax cut in 30 years, and for many, it was. It lowered rates, doubled the standard deduction, and doubled the estate tax exemption. However, under the obscure budget rules of the United States Senate, specifically the reconciliation process, a bill cannot add to the federal deficit beyond a 10-year window if it is passed with a simple majority. To make the math work, Congress had to make a choice. They chose to make the corporate tax rate cuts permanent. They locked those in. But the tax cuts for you, the individual, the family, the retiree, were given a sunset clause. They were designed to expire on December 31st, 2025. Corporations got certainty. American families got a countdown clock, and that clock is running out. So what exactly happens when we wake up on January 1st, 2026? The reversion is automatic. Let's look at the brackets. The current 12% bracket, which covers a huge portion of middle-class income, will jump back to 15%. That is a 25% increase in the tax rate for that specific slice of income. The 22% bracket climbs to 25%. The 24% bracket jumps to 28%. The top marginal rate goes from 37% back up to 39.6%. But the bracket percentages are only half the story. The standard deduction is the silent killer here. Currently, a married couple filing jointly enjoys a standard deduction of over $29,000. This means the first $29,000 of your income is effectively tax-free. In 2026, that number gets cut roughly in half, dropping down to around $16,000. That means an additional $13,000 of your income that was previously tax-free is suddenly fully taxable. Furthermore, the estate tax exemption, the amount of money you can pass to your heirs without the government taking a 40% cut, is set to be cut in half. Right now, a couple can protect over $26 million. In 2026, that drops to roughly $13 million or less per couple. If you have built significant wealth, the government is preparing to take a much larger slice of your legacy. Here at Tax Hack Pro, we focus on the actionable reality of these changes. And the reality is that this tax hike is asymmetric. It hurts retirees significantly more than it hurts the working population. This brings us to the concept of income rigidity. When the government raises taxes on a 30-year-old worker, that worker has options. They have income elasticity. They can negotiate a raise. They can work overtime. They can switch jobs for a higher salary. They can start a side hustle. They can contribute more to a pre-tax $401,000 to lower their taxable income. They have levers they can pull to offset the loss. Retirees do not have these levers. You have income rigidity. Your Social Security check is determined by a formula set in stone. Your pension payout was decided the day you retired. Your savings are a finite pool of capital. You cannot simply work harder to offset a tax hike. When the government demands a higher percentage of your income, you have only one choice. You must withdraw more money from your savings to maintain your standard of living. This creates what we call the portfolio death spiral. Let's walk through the math. Imagine you need $5,000 a month to pay your bills, mortgage, utilities, food, healthcare. In 2025, to get that $5,000, you might need to withdraw $6,000 from your IRA to cover the taxes. But in 2026, when rates go up and deductions go down, you might need to withdraw $6,500 from your IRA to net that same $5,000. Here is the trap: that extra $500 withdrawal is taxable income. By withdrawing more to pay the tax, you increase your taxable income, which might push you into an even higher tax bracket, which increases your tax bill further, forcing you to withdraw even more. It is a vicious cycle. Unlike the worker who generates new wealth, the retiree is forced to cannibalize their nest egg at an accelerated rate. Every extra dollar you withdraw for taxes is a dollar that can no longer grow and compound for your later years. Let's put real numbers on this. Consider a retired couple. Let's call them Robert and Linda. They have a total household income of $75,000. This comes from a mix of Social Security, a modest pension, and IRA withdrawals. Under the current 2024-2025 tax laws, their standard deduction wipes out nearly $30,000 of that income. Their taxable income is low, and most of it falls into the 10% and 12% brackets. Their total federal tax bill is manageable. Fast forward to 2026. They still have $75,000 in income. They haven't become richer. Their purchasing power hasn't increased. In fact, due to inflation, it's likely decreased. But suddenly, their standard deduction drops to $16,000. Now, instead of $45,000 being taxable, nearly $60,000 is taxable, and that income isn't being taxed at 12%. Much of it is now being taxed at 15% or higher. Without earning a single extra dime, Robert and Linda could see their tax bill increase by $2,000 to $3,000. That is money that was earmarked for groceries. That is money for the electric bill. That is money for grandchildren. Gone, vaporized by a sunset clause written nearly a decade ago. But the brackets are just the tip of the iceberg. There is a hidden trapdoor in the tax code that most retirees don't see until they fall through it. It is the Social Security Tax Torpedo, and the 2026 sunset makes it exponentially more dangerous. To understand this trap, we have to travel back in time to 1984. The Reagan administration passed a law that, for the first time, allowed the federal government to tax Social Security benefits. But they promised it would only affect the wealthy. They set specific income thresholds. If your combined income was under $25,000 for a single filer or $32,000 for a married couple, your benefits remain tax-free. Combined income is a unique IRS formula. Your adjusted gross income plus non-taxable interest, like municipal bonds, plus 1/2 of your Social Security benefits. Here is the scandal. Since 1984, Congress has never updated those thresholds for inflation. Not once. Think about the purchasing power of $32,000 in 1984. Today, you would need nearly $100,000 to buy the same amount of goods, but the tax threshold is still stuck at $32,000. In 1984, this tax hit less than 10% of retirees. Today, because of 40 years of inflation, it hits over 50% of retirees. It affects the middle class. It affects people who are barely scraping by. The government effectively let inflation do their dirty work, dragging millions of seniors into a tax web that was never meant for them. Now combine this outdated threshold with the 2026 sunset. When your tax rates go up in 2026, you might need to withdraw more from your IRA to pay the bills. That withdrawal increases your combined income. That increase pushes you over the 1984 thresholds. Suddenly, up to 85% of your Social Security check becomes taxable. And that taxable Social Security is then taxed at the new, higher 2026 bracket rates. It is a double whammy. You are paying tax on more of your Social Security, and you are paying a higher rate on that tax. This interaction between withdrawals and Social Security taxation causes effective marginal tax rates to spike to over 40% or 50% for some middle-class retirees. You withdraw $1, but you lose 50 cents to the varying tax interactions. Then comes the third strike: required minimum distributions, or the government allowed you to defer taxes on your $401,000 and IRA for decades. But they will not wait forever. Under the Secure Act 2, the age has moved to 73, but the mandate remains. You must withdraw a calculated percentage of your account every year, whether you need the money or not. If you have been a diligent saver and built a nest egg of $1 million, your RMDS can be substantial, $40,000 or more a year. In 2026, the government will force you to take that money out, and they will force you to pay the new, higher tax rates on it. You have no choice. If you refuse, the penalty is up to 25% of the amount you failed to withdraw. So let's look at the triple squeeze awaiting you in 2026. Higher rates. Your base income is taxed at higher percentages. Broader base. The standard deduction cut exposes more of your income to taxation. Stealth taxes. The interplay of RMDS and frozen Social Security thresholds triggers taxes on benefits that should be tax-free. This sounds grim, and it is, but here is the silver lining, and this is why you subscribe to Tax Hack Pro. The sunset hasn't happened yet. We are in the final approach. The years 2024 and 2025 are your golden window of opportunity. The tax laws are currently known, and rates are historically low. You have a limited time to rearrange your financial furniture before the house catches fire. What can you do? We have identified specific strategies to insulate your wealth from the 2026 reversion. Strategy number 1, strategic Roth conversions. This is the most powerful tool in your arsenal. A Roth conversion involves taking money from your traditional, pre-tax IRA and moving it to a Roth IRA. You willingly pay taxes on that money now, in the current tax year. Why would you volunteer to pay taxes? Because you are paying them at today's sale prices. You pay the tax at the current 12%, 22%, or 24% rates. Once the money is in the Roth, it grows tax-free, and qualified withdrawals are tax-free forever. Even better, Roth IRAs do not have RMDs during your lifetime. You eliminate the government's ability to force you to withdraw money in the future. You are effectively buying tax insurance. By paying the tax now, you protect that money from the 2026 tax hike and from any future tax hikes Congress might dream up 10 or 20 years from now. The goal isn't to convert everything at once. That would push you into a massive tax bracket. The goal is to fill up your current low bracket. If you are in the 22% bracket and have $10,000 of room before hitting the 24% bracket, you convert exactly $10,000. You top off the bucket. Strategy number 2, tax gain harvesting. Most people know about tax loss harvesting, selling losers to offset gains. But right now, we have a unique capital gains tax environment. For married couples with taxable income under roughly $94,000, the long-term capital gains tax rate is 0%. 0. If you are in this bracket, you can sell stocks that have gone up in value, pay 0 federal tax on the gain, and then immediately buy them back. Why? You have just stepped up your cost basis. If you bought a stock at $50 and it's now $100, and you sell and rebuy at $100, your new basis is $100. If you sell it later at $110, you only owe tax on the $10 growth, not the original $50 growth. You have washed away the tax liability for free. This window works best before income definitions potentially tighten or rates change. Strategy number 3, accelerated income. This goes against traditional advice, which is usually defer, defer, defer. But if we know taxes are going up, deferral might be a mistake. If you're planning to take a large withdrawal from your IRA for a renovation, a car, or a dream trip in 2026 or 2027, take it now. Take it in 2024 or 2025. Pay the tax at today's known, lower rates. Stick the cash in a high-yield savings account if you don't need it immediately. Do not wait for the bill to arrive when the price of admission has gone up 3% or 4%. Strategy number 4, the widow's penalty defense. This is a grim topic, but essential for couples. When one spouse passes away, the survivor usually inherits the assets, but they lose the married filing jointly tax status. They become a single filer. Their standard deduction gets cut in half. Their tax bracket thresholds get cut in half, but their income, pensions, RMDS, investments often remains nearly the same. This pushes the surviving spouse into drastically higher tax brackets. By performing Roth conversions now while both spouses are alive, you're utilizing the married brackets to pay the taxes. You are essentially prepaying the taxes for the survivor so they don't face a massive tax bomb while grieving. Strategy number 5, qualified charitable distributions, QCDS. If you are over age 70 and a half and you give money to charity, stop writing checks from your bank account. Use your IRA. A QCD allows you to send money directly from your IRA to a charity. This counts toward your RMD, but it does not count as taxable income. This lowers your adjusted gross income. By lowering your AGI, you might stay below the thresholds for the Social Security tax trap or the Medicare IRMAA surcharges. It is the most efficient way to give, and it bypasses the tax hikes entirely because the money is never taxed. Now the inevitable question, will Congress stop this? Will they extend the cuts? Washington is unpredictable. There is a chance they could pass a last-minute extension. There is a chance they could compromise and keep some cuts but raise others. But hope is not a strategy. If you plan for the sunset and convert to a Roth, and then Congress extends the cuts, what have you lost? Nothing, you've still moved money into a tax-free account at a low rate. You've still eliminated future RMDs. You've still protected your surviving spouse. However, if you sit back and hope for Congress to save you and they deadlock, which happens constantly, you will wake up on January 1st, 2026 with a permanently devalued portfolio. You will have missed the window. The cost of preparation is zero if you're wrong, but the cost of inaction is massive if you're right. The 2025 tax sunset is the single biggest known threat to retirement wealth in this decade. It combines higher rates, lower deductions, and an aggressive attack on fixed incomes, but it is a threat with a solution. The solution is proactive planning. It requires you to stop looking at your taxes in the rearview mirror, only filing for what happened last year, and start looking through the windshield at what is coming next. This is the mission of Tax Hack Pro. We don't want you to just pay your taxes. We want you to win the game. The government has set the rules, but you have the right to play your cards in the most efficient way possible. Do not let the calendar turn to 2026 without a plan. Talk to your CPA. Talk to your financial advisor. Model these Roth conversion scenarios. Look at your 1984 Social Security thresholds. The math is clear and the clock is ticking. If you found this breakdown helpful, if you want to stay ahead of the IRS and protect your retirement from the silent grasp of inflation and legislation, you need to be part of this community. Hit that subscribe button right now. We are tracking every move Congress makes regarding the 2026 sunset, and we will update you the moment strategies need to shift. Does the Social Security tax threshold surprise you? Are you planning on doing a Roth conversion this year? Let's get a discussion going so we can all learn from each other. Share this video with your friends who are retiring soon. Most people have no idea this tax cliff is approaching. Now you do, you have the knowledge. Use the time you have left. I'll see you in the next video.